Are you an overwhelmed SaaS founder ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those you don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where we aren't saying we're unfit, but, we just tried mud wrestling and the mud won. I'm Jeff Maines. I help B2B SaaS founders like you profitably scale and exit, creating profitable growth, premium valuation, and shift from being an engaged operator to an empowered owner. So yeah, it's been pretty muddy. We've had a ton of rain recently. Usually around Dallas, you really don't need a four-wheel drive, and people get them as a status symbol, or maybe because the ramp at the Galleria parking garage is icy once a year. But last week, everything is just so muddy and soft. But on the upside, with all the rain, fishing is getting better. So I guess the best solution is get on the water, stay off the land. That sounds like a pretty good solution to me. Well, recently, a small cafe in Australia made some pretty big headlines for their unique approach to customer service. And this is not your normal customer service kind of story. The cafe decided that they would offer a menu they called the Lies menu. This is where customers could order a meal and then be served anything the cafe felt like giving them. The catch was that the customers had to eat the food without complaining or sending it back, no matter what it was. Now, the cafe owner explained the concept was a way to bring some humor and lightheartedness to the dining experience, and also to challenge customers to be more open-minded and spontaneous. I think it's really interesting. The Lies menu quickly became a hit among locals, and soon customers were lining up to try their luck and see what kind of surprise dish they would be served. Of course, the story went viral on social media, with lots of different people praising the cafe's creativity and entrepreneurial spirit. It even attracted international media attention, all the way over here in the States, and journalists, food critics coming from all over the world to try the Lies menu for themselves. Cafe became a must-visit destination for foodies and thrill seekers alike. The owner was able to turn a simple cafe into a popular tourist attraction. Now, a lot of you probably know that restaurants have incredibly high failure rates, one of the highest of any business category. I really admire the brilliance of standing out in a crowded market. It's a wonderful example of creative differentiation, and it also shows the power of using humor and unexpected experiences to create a memorable and enjoyable customer experience. So that's what I like to call surprise and delight. Well, if there's one thing that doesn't lie in business, it is numbers. And our guest today is a straight shooter, no lies menu there. In fact, he built his business based on total transparency, using a SaaS finance framework that transparently links operations to finance in order to help SaaS growth boom. Today's episode is sponsored by Champion Leadership Group. Get free growth tools and map out a growth plan to scale your SaaS business to 8 figures and beyond. Travel with fellow SaaS entrepreneurs on your growth journey using a proven methodology that is mentor-guided, results-focused, and peer-supported. Celebrate wins and quickly rebound from setbacks to achieve profitable growth, impact, and freedom. Unleash your SaaS growth at championleadership.com. In our founder episode this week, on Tuesday, we talked with Drew D'Agostino, founder and CEO of Crystal, a personality data platform that helps businesses understand their customers and build more emotionally intelligent sales teams. It's the kind of insight and communication that makes clients fall in love with your SaaS. And last week, Sarah Hawley, founder and CEO of Growmotely, on our Expert Series. Remote work unlocked explosive growth for her company and facilitated 3 exits. Now she and Growmotely help thousands of other companies find that same freedom and expansion in a global talent pool. So if you missed either episode, definitely go back and give them a listen. My guest this week is one of the top financial experts in all of SaaS land, Ben Murray, the SaaS CFO. Ben is an advisor, educator, consultant, and fractional CFO. Sometimes financial reports, metrics, ratios, and all the alphabet soup of measuring business performance sounds like a foreign language. Especially to us tech leaders. And the old traditional educational explanations, not super helpful. It's like trying to teach a ferret calculus. But Ben has a gift. He simplifies SaaS finance for busy B2B entrepreneurs in a way that only a few people can. Lots of great education is available through the SaaS Academy. About 6 years ago, he started a blog giving total clarity on SaaS metrics. Now his community is just under 50,000 members strong. Every week, they're getting Ben's firsthand knowledge on how to monopolize the metrics and make their SaaS a success. Welcome one of the smartest financial people I know, Ben Murray. Well, hey, Ben, welcome to SaaS Fuel.
Great to be here. Thanks for having me.
Well, you are the SaaS CFO. How did you get into SaaS, or has it always been a part of your practice?
Yeah, my background, of course, is finance and accounting. Came up through the ranks of FP&A and actually worked in the airline industry and then got into software, back to airlines, and then stayed in software. So actually, my route was a couple different industries and then up through FP&A. And then got into software back in the day when it's on-premise software, perpetual licenses, charging maintenance every year. And then, of course, now the evolution into SaaS.
Oh, that's great. It's a very interesting path, airlines to software and then to SaaS. What does that evolution look like for you, going from on-premise to SaaS? And how do you think that's changed as a business model?
Yeah, really interesting because I still remember sitting at my desk. I was a senior financial analyst working in healthcare tech, and the GM of that business unit came to me, and this was in the 2000s, early 2000s, and he said, "Hey, Ben, come up with a subscription model for our on-premise software." So, of course, still hosted on-premise, but he said, "See if you can figure out a subscription price." And I still remember that project, opening up Excel and trying to figure out, okay, what are the costs to deliver this? To deliver the software, what should we include here? So just from scratch. And of course, this was, Salesforce was already out there. So there's some cloud offerings, but this was so new. So still remember that. And then just that transition from, all right, let's create a subscription model, the whole ASP thing, to then starting to slowly learn those metrics and thinking about how we manage SaaS businesses and recurring models. So it took time. It wasn't just an overnight thing where we have a subscription price and then we have CAC payback period and gross dollar retention, net dollar retention. It took time for that to evolve.
Yeah. That's when I started too, was the ASP days.
Mm-hmm.
SaaS wasn't really even a term out there for a while yet. And that was really interesting, the transition and trying to sell both, where we had two different options and companies weighing that out.
Mm-hmm. Yep. Yeah, definitely. Yeah. It was evolving and just learning on the fly and experimenting. And I remember we had to go to the big boss of the whole healthcare tech division to get that pricing approved, so brand new stuff. New offering, so still remember that. That was kind of my first taste of the subscription model.
So where do you see the industry going forward from here? As the SaaS is kind of eating the world. Do you see that continuing? And what do things look like, say, 10 years from now?
Yeah, I think, it's evolving. It's, like SaaS 1.0 was just subscription revenue. I charge $50 a month or $12,000 a year. And that was subscription, SaaS 1.0. And now, I work with so many different SaaS companies. It's rare, unless you're early stage startup, which makes sense, that you have just subscription revenue. But now there's so many different revenue streams with technology companies. So we have subscription. We have the whole variable revenue component, which could be usage, transaction, consumption, processing. I've had one SaaS company or client who had, I think, 5 different revenue streams because they're point of sale. So they had subscription, they had some processing, they had some variable revenue, they had hardware revenue, some services revenue. Now it'll be the hard part will just be keeping up with the evolution of how we deliver software and price it and how we create value from the software. And for those like me, a CFO, it's like, boy, how do we now invoice? How do we bill? How do we do rev rec? And staying up with the delivery of revenue and how we're creating value for our customers.
I guess that's really the next logical question is how do you deal with that as a CFO? Do you like multiple revenue streams, or do you like it more consolidated where it's easier to capture?
I think deliberate revenue streams is great. Having different ways to monetize, of course, as a CFO, I love. But, say PLG, right? Product-led growth, kind of the popular thing today. And well, should we do that? Does it make sense based on how we developed our product and how we deliver our product? So I don't think we should just jump right into certain things because they're popular, but we have to think about, again, how we're delivering value to our customers and which revenue streams make sense. But of course, as a CFO, I kind of think like sales too. If we have different pricing, different ways to expand our customer base, I'd love it.
And that's one thing I really love about you, especially in this market, is that while a traditional CFO might just be very conservative and not really have that sales hat, you really have that financial background and the sales hat together in two places that a lot of times in companies are opposed to each other. So operations or finance and sales, butt heads a lot, but you're kind of the blending of both of those.
I think that's the SaaS CFO today has to be there where, right, we have to push back, we have to be critical, but we also have to facilitate, enable all the departments in our SaaS business. So CFOs, especially in SaaS companies, the departments I spend a lot of time with, definitely sales, probably top of the list. What's going on in sales? What's the pipeline? What's the forecast, the commit? Marketing, a lot of discretionary spend in marketing. So I found myself when I was an in-house SaaS CFO really spending a lot of time with sales and marketing. Of course, working with all the services, customer success, et cetera. But that was probably one of those top departments where you spend a lot of time and really trying to understand their business model, their go-to-market motion. And right, CFOs do want to deploy capital. We don't just want to say no. So we have to figure out, it's always that fine balance of pushing back, but also helping those department leaders.
Yeah, that interactivity is so important. I think you're right. Having them working together to deploy capital in smart ways, because you don't want to just have a blank check, and we see that a lot in some venture funded companies that are deploying capital in crazy ways.
Yeah, and obviously that's changed in 2023 and late 2022 now, where a lot of growth. Now it's financial discipline, and I love saying financial discipline never goes out of style. Of course, it's very in style. Rule of 40, trade-off between profit and growth. So now looking at cash runways and how we can efficiently deploy capital. Should we expand our existing customer base? Because based on the numbers, right, that's more efficient than acquiring new customers. So that's where now SaaS companies really have to be dialed in with their metrics and their unit economics.
So what are the key metrics that SaaS founders should be paying attention to, particularly when it comes to finance and how they're using capital and the return on that?
Yeah, I mean, you can always, I work with my 5-pillar SaaS metrics framework, which covers growth, retention, margins, financial profile, and then efficiency. So for founders thinking about this, one, it's back to the basics of fundamental financial management with SaaS companies. So thinking about our gross margin. How is our gross margin right now? Our margins by revenue stream. For pure play SaaS, I'm shooting for 80% best in class gross margins. So how does that look? Where are we trending? Because that can create a lot of cash flow if we have good, efficient delivery of revenue. And then our OpEx profile, R&D, sales, marketing, and G&A. How much are we investing there? And of course, when we focus on sales and marketing, we have efficiency metrics tied to those departments. So cost of ARR, CAC payback, maybe the magic number as well. So, looking at those to see how we're deploying our capital. Is that efficient? Should we pause? Should we invest more? Should we cut back? And that's really important today.
And how do they balance that versus, kind of the traditional of the last 5 years or so of growth at all cost?
Yeah, I think before, right, growth, grabbing market share, really pushing that top line. And then, all right, let's raise a round in 18 months and another 18 months to continue to push that growth. And now we can't rely on that capital coming into our business, say, every 1 to 2 years to continue to push growth. So now it is, and with the clients that I'm working with, we're looking at that cash runway. We're looking at that balance. How much can we invest to still self-fund our business? Or how can we make this cash last so we can get to closer to a sustainable business? So now it's really making those hard decisions on hiring, on spend levels, and there's some tough choices right now.
That makes sense. If a founder is looking to raise or potentially exit, what are some things that they should be thinking about, and how soon in advance of that event should they be planning?
Yeah, planning. I mean, I think minimum 6 months out. For me, when founders reach out and, hey, I'm going to raise money in 2 or 3 months, I need metrics, I need a forecast. It's like, hey, it's too late, right? That's just too soon, unless they have just great data right now. But I think you need to be when founders come to me and they're thinking, hey, it's a couple years down the road, beautiful, perfect. I love that. We've got time to clean up the data, to put the right systems in place, to calculate the metrics, create an accurate forecast. So that takes time. It's a journey to get a good grasp of your financial profile. So, I think if you're trying to scramble, it's hard. And, I interview a lot of SaaS founders for my podcast. And, one I actually just did another day is if you can go into a fundraising round, his advice was if you can go in with a position of strength where you don't really need that capital and you can walk away, that's great. So, there are a lot of tips and tricks with fundraising when talking to founders, but I think you have to have a really good grasp of your numbers and time to prepare so you can speak that same language when those investors start asking you about your business.
Yeah, I think that definitely affects multiples as well.
Oh, yeah. Going in to maybe have a sense of maybe what revenue multiple I'm going to get, from my business based on where I stand. Am I early stage where it's more about the story and the growth, or am I later stage and it's my overall financial profile, it's my retention, it's my sales and marketing efficiency. What are those numbers saying? And how will investors interpret those?
That makes a lot of sense. How should founders be thinking about advisors in the process?
Boy, it's interesting now because early stage SaaS, now you can supplement your business. You have that flexibility to bring contractors in, contractors off. You can bring fractional CFOs in like myself. And I'm seeing fractional CROs. I'm seeing fractional chief operating officers. So I see a lot of use of that with companies, say less than 10 million in revenue, to bring that experience in because they're trying to scale. They're trying to get to that next step, and the founders don't have that experience. They recognize that. So seeing a lot of use of fractional services that's more efficient, and more budget friendly than hiring these full-time positions in their business. So I see a lot of use of that to supplement the founder's experience.
I think you're exactly right. That's something that we're seeing a lot more of than even 5, certainly 10 years ago. Things like that just didn't really exist. But to be able to bring in that expertise for a short period of time to get you to that next level is priceless.
Yeah, it's so common now. And when people, talk to me about SaaS and like what I do, and it's like, well, do you have local clients? It's like, no, actually no local clients here in the Denver area. It's all global. And because SaaS,
Sure.
we're used to that. We're used to working, say, remote, working with people all over the world. And it's just so common. So bringing that the fractional folks in, contractors in, just makes a lot of economic sense for founders.
So where do founders get in trouble from a financial perspective? Is it in reporting or the way that they're calculating maybe revenue or recognizing that? Or what are some of the challenges that you've seen?
Yeah, I think the challenge is there is a repeatable cycle that I see every time, and things that I work with SaaS companies fix. One, it may not be sexy, but it's always the accounting foundation, right? We've got to have good, clean, accurate books that are timely. So it starts with their good detail. We've coded our revenue streams correctly. Hopefully we have rev rec in place or revenue recognition in place at some point, and just good, clean financials. Then from there, a SaaS P&L so we can see our revenue streams, so we can see our margins, so we can see our OpEx profile and the EBITDA. And then from there, we can calculate metrics relevant to our business. So I think one is just that foundation of having the proper accounting in place, having some of the basic reports in place that we can manage our business with. And then I think some founders are always eager to continue to ramp up spend when maybe they shouldn't. And it's like, hey, we've got to pause here. We've got to fix the business first before we even think about incremental headcount. And sometimes that's really tough. And especially today, I think it's hard for them to kind of pull back when, because just the cash isn't there for them.
Right. Well, you mentioned SaaS P&L. How is that different than a traditional P&L?
Yeah, because I think each industry is different. You think, say, like manufacturing, which I don't know anything about, but right, you think about, hey, I'm selling some, like hardware, and there's a direct cost, a hard cost attached to that physical good I'm selling. And that P&L is going to look a lot different than a SaaS P&L, where with a SaaS P&L, say pure play SaaS, in our cost of goods section, usually we'll have professional services if applicable, right? The setup, onboarding of our customers and training. We'll have customer success. Now that's debatable depending on what they do, if they should be up there below gross margin. We'll have tech support, and then we'll have DevOps, say our hosting architecture, and then below that R&D, sales and marketing, and G&A. And that's pretty much, there are many standards in SaaS, but I'd say that's the pretty common SaaS P&L setup that we need to manage our business.
When you have areas like that are maybe gray areas, you don't know whether client success belongs above the line or below the line, how do you make that decision?
The customer success area, there is definitely a debate. I teach that in my SaaS metrics course, but I think if they're, say, focused on retention, the success of the customer, and they may look for opportunities to expand that customer, but they hand that lead off to sales, then I'd say they belong in COGS, they belong in your gross margin. Of course, they could have a bonus. They could have a bonus on retention targets, for example, but they're not trying to close those deals. It's fine to prospect for those leads, hand them over. But if they're also, hey, how's it going? I see you're using the product this way. It looks good. You could use these other features, but oh, by the way, we've got product B. Would you be interested? Okay, sure. Let me get a contract for you, and they'll get commission off that. Then that's a mix where it's customer success as well as, say, an account management role that you're focused on expanding the revenue from that customer.
Yeah, that makes a lot of sense. So it's not just, I want my gross margin to look better, so I'm going to put them below the line.
Yeah, right. Yeah, you have to be careful with that you're not manipulating the P&L because eventually people will see through that if they ask enough questions.
Yeah, and that's the last thing you want to happen in an investor meeting or when you're trying to raise or exit is to have weird things or questions like that come up.
Yeah, and I always say it's like, yeah, make your numbers, make your financials just easily consumable for investors, your board, potential investors. Don't give them a crazy 50-line P&L that they're just not going to know what to do with or how to read. So just make it easy for investors, or if you're going through a raise, for those potential investors.
And I think that may be different than what we look at internally as founders, because we may want to know some specific line item detail or things that don't necessarily make sense outside.
Oh, yeah, definitely. Right. We have the SaaS P&L, then I'll have a different view of the P&L that is maybe by expense category. So a lot of ways to slice and dice the data that we need internally. Our department leaders need, to know where are they spending money internally for each department. So hopefully two roles, right? We're not just creating stuff for investors or potential investors, but we use it in our business as well that can then be repurposed for any sort of external reader.
And early on in my journey, that would have been a really novel concept. That those two things are different, things that investors are looking at or the board is looking at versus internal management P&L.
Mm-hmm. Yeah, now, and that's when I talk to SaaS founders and my SaaS clients, right? It's twofold, right? We're putting this process in place, this financial foundation in place to manage the company, to operate the company, to scale the company. But also, we can use that same data, the same reports, the same metrics to provide to investors because they should be looking at the same metrics that we're looking at internally.
And how are companies looked at differently based on fundraising, whether it's an A round or B or C or later stage? How does that change over time?
Yeah, I think it changes, say, from seed and Series A, from the story, the addressable market, the founders' backgrounds, co-founders' backgrounds, and that excitement that you're selling, that story you're selling. You're not going to have many numbers yet, not much revenue. And so it's about the story. And then that evolves, right? Over time, then they do expect numbers. They do expect forecasts, 3-year forecasts, sales and marketing efficiency metrics. So it goes from the story to still the story. I mean, the story is important through every round, but then you can support that story with your numbers and your metrics.
So there's a lot said about raising capital and rounds and things like that, but it's certainly not the only way. What are other ways that founders raise capital that do you see that work really well?
Yeah, instead of, say, equity investments now, really the hot thing, the popular thing right now is the alternative financing, say revenue-based financing, MRR-based financing. So really just debt, that's, you could say, collateralized by your recurring revenue. So that's really popular. You're seeing a lot of debt providers pop up that are even just specific to SaaS companies or recurring revenue businesses. Now, the cost of capital might be a little higher than, say, a US SBA loan or going to your local bank, which that, could be a better cost of capital, but just takes a lot longer to get through. Sure. But, with these, it's really popular debt, no covenants, just some basic reporting that you have to provide, and you could get your capital within a week, so really flexible. So that can be used for It can fit with a lot of businesses depending on what they're needing that capital for.
That makes a lot of sense, especially just the speed and the flexibility. being able to do that. And debt doesn't participate in the upside. So if you really think that you're going to grow, and as a founder you should, then that's really, I would think, attractive to a founder, is looking at debt versus equity.
Yeah, definitely. You still have to be careful. You still have to know those terms and conditions, the covenants, to make sure there are no warrants at the end or some sort of equity event when you pay off that debt. Because I've seen different things. I work with founders in the US, also Canada, and a little bit global, where Canada, say, is a little bit different when they get some financing, some debt financing. But still, you do have to make sure. But there are a lot of providers now where, there really are no strings attached as long as you can repay that debt. They don't participate in any upside in your company. They want to continue to provide debt over time. And that, I think that's the upside to the debt lenders, is it's not just one and done, but we want to be continue to be a capital source for the SaaS business.
Right. And how has the increase in interest rates affected debt financing? Of course, we've seen somehow it's affected valuation and the equity financing.
Yeah, right. The cost of money, as that goes up, that affects those lenders. I've seen, these offers like, hey, check out this offer because 2023 it's going to change, which makes sense, right? Their cost of capital, where they're getting their money from, and those investor expectations are a little bit different. So it does put pressure on those rates. And again, for me, it's whenever SaaS founders look for debt financing, right? Let's just look at our cash flows, our cash flow from operations, just make sure we can absorb this payment every month within our existing cash structure.
Yeah, so not taking money, hoping to grow into being able to make that payment.
Yeah, that'd be pretty risky. Yeah, if you're, unless you have say you've really refined your go-to-market motion, you know where to invest this capital, and you know the ROI on that, then maybe that could be a little bit different story, and maybe still you'd feel a little nervous, but that'd be a potential. But yeah, if you're going to have trouble with that first payment, then it's probably not a good choice.
Sure. Well, in a market like we're looking at 2023 and potentially beyond into the next, who knows what the next year or two will look like. What do you think that the risk is of doing that? And because essentially you're taking that revenue now instead of spreading it out over time when you're doing debt financing.
Yeah, I think, it still has to make fundamental sense for your business. So what, the debt founders I talk to are debt providers, they love to finance growth. So it's like, hey, where are you investing in this? It's usually not to say, do a recap. Maybe they can do that, but it's usually some purpose, invest in the product, invest in sales and marketing. So I think the fundamentals are still there. It just could be a little bit harder to forecast your revenue over the next 12 to 24 months. Based on the market conditions right now. So I think you do have to be a little bit more conservative in your forecast, because for CFOs, right, we always have to look around the corner. What's coming up that we don't expect? So I think you have to, forecasting is so important now.
Sure. And what kind of forecasting timeline do you think makes the most sense for companies?
Yeah, I think huge fan of forecasting. You have to forecast at least once a month in your monthly financial routine. But I say you forecast it as often as your data is changing. So if assumptions are changing rapidly week to week, well, maybe we're producing a forecast every week, a new one that forecasts out the next 12 months. But if we have a pretty static business, things aren't changing fast, then the urgency is there. You still have to forecast once a month. You'll forecast out the fiscal year, the next 12 months. But if things are rapidly evolving, rapidly changing, then the forecast has to keep up with that.
That makes a lot of sense. Well, tell me about the SaaS Academy.
Oh, sure. Yeah. So I've got the SaaS Academy with the THE in front of that, .com. And so through that, I have free and paid courses on SaaS metrics and finance, all my webinar replays. So I've got a ton of content, just on accounting topics. I bring guests on. I had one guest on, on how to prepare your SaaS business for sale, for example. So a lot of topics on metrics, on forecasting, on budgeting. And so it's really just trying to educate SaaS founders, SaaS investors, finance, accounting, CFOs, et cetera, on all the details around SaaS-specific finance.
That's brilliant. And some fantastic content there as well.
Oh, thanks. Yeah, I just post on LinkedIn today. I've got the SaaS Finance 101 course for SaaS founders. Just the basics, right, of understanding a P&L, understanding balance sheet, understanding cash flow. So trying to get some founders in there. Say, hey, no strings attached. It's free right now. Get in there and enjoy it.
Well, it's really helpful too, because a lot of SaaS founders come from the development world. Or like me, I'm not a developer, but it's marketing. And so unless you actually have somebody to actually teach you that, or maybe you took some finance in college, which may have been a long time ago, yeah, it's really helpful to know that and think about, what do we need to be looking at? What do we need to track? Yeah, how do you read a P&L? How does an investor look at a P&L? What are the things that they're thinking about when they're looking at that? So, even just, from it's different looking at it as a manager than it is as an investor.
Yeah, I mean, SaaS founders, right? They're so busy, busy 7 days a week that my experience, they don't really have time to take these long, intensive courses. So I've tried to make these small bite-sized video lessons. But yeah, I'd say 1 in 10 SaaS founders I talked to maybe had a finance and accounting background. Most, right, are technical background or maybe sales and marketing, or they were working for a company in that specific skill and then started a company. So rarely it seems like they can run with a forecast, an extensive complex forecast model or talk SaaS metrics. And a lot of them come to me, and they're like, I just want that basic education, just kind of teach me those basics, which I think is really important for them to understand.
Oh, that's great. And I can't believe it's free. I mean, that is just fantastic. So if you're listening to this and you have not done that, go sign up, because that is it's an unbelievable deal. Super value.
Yeah, because they're so busy, it's like just kind of learn along the way. Learn the P&L, how to read a P&L, balance sheet, cash flow, etc., which will help down the road.
Without a doubt. And you also have SaaSnews.com.
Yeah, so I've got the SaaS News, THE, SaaSnews.com.
You like that THE at the beginning, right?
Yeah, there are only so many domains available. And it was, I started out as the SaaS CFO.com, THE, and I was inspired really, I don't know if people read the Points Guy. It's a newsletter and website on travel and credit cards and taking advantage of all that stuff. So that kind of inspired me to grab, I think SaaSCFO.com was taken. So I was like, well, how about the SaaS CFO? And that's kind of how it evolved. SaaS Academy was taken. So I did the SaaS Academy, now the SaaS News.
I like it.
Just kind of stay consistent.
Yeah.
Yeah. So I've got the SaaS News site that I started over a year ago as well, covering fundraising events, interview a lot of SaaS founders through that site as well. And just to share private SaaS company news. So it's purely to help out SaaS companies get more eyeballs on their company. So really, really fun talking to a lot of founders that way and just trying to spread the word for them.
That's great. And there's so many great companies out there that are trying to just break through the noise. And so I really appreciate sites like that help them do it.
Yeah, I mean, we've covered now, I think it's like 4,000 fundraising events over the last year and a half, and it's just crazy. And can't say that we cover them all, but we try to, like, pre-seed to Series X rounds, even debt rounds. And, so just so much going on in the space, and it's truly global, just everywhere, every niche, serving every different thing. Just amazed every time I talk to a SaaS founder, their background and the problem that they're trying to solve.
Yeah. So what are the biggest challenges you've seen in working with SaaS founders, particularly when it comes to finance or funding the companies?
I think it's trying to bridge that gap between the numbers and operations and making it understandable, right? Because I live and breathe numbers and spreadsheets and calculate, 10, 15, 20 different SaaS metrics, but then trying to make that actionable for SaaS founders so they can understand it, so their executive teams can understand it. I may look at it, it's like, yeah, because I live and breathe that, but trying to make it useful for founders so they can take action on that. So I think, and that's not the founder's fault, but it's more on the CFO to be able to educate them on what this means, what should they do next. So I think that big piece is just translating the numbers into something operational and actionable.
That makes a lot of sense. One of the things I wrote down a note that I don't remember what it means from our last conversation, and I just wrote down plans, what to do, engineer profile 3 to 5 years. Do you remember what that was?
Yeah, I think, I don't know. I mean, 3 to 5 years, like sometimes, right, investors, going through due diligence, they want 3 to 5 year forecasts, which are very difficult to do, but kind of a check the box type thing. So, I get a lot of those requests, from founders, and they're like, hey, they're asking for this long-term forecast, right? And those
Oh,
are
okay, gotcha.
always so hard. So it could, pertain to that.
Okay. So there's a lot of different revenue models, whether it is kind of the traditional subscription, seat based, and usage based. We're seeing a lot more of. How do you see that playing into valuations? Predictability versus kind of the old school predictability of here's the license fee.
Yeah, I'd say there's a lot of debate on that. From my perspective and folks that I've talked to, that the king at the top of the valuation pyramid is still contracted subscription revenue, whether it's contracted MRR, contracted AR, because it's predictable. Right? The word, you've contracted for it. So with variable revenue streams or usage-based pricing revenue streams, if it can go to zero, it's going to be harder for that to be valued as high as contracted MRR ARR. And we saw that in the pandemic. Some, even with usage-based, thrive, but others, it went to zero. And so I think investors, at least from a valuation perspective, still like that predictable revenue for contracted MRR or ARR. Now, if you have variable revenue or usage-based pricing with some tiers, some minimums, now that's better than if it can go down to zero. So I think probably a lot of lessons learned in the pandemic, if we had pricing models where the customer could just completely stop using the product, which resulted in zero revenue for us, or should they be a minimum or a platform fee plus usage-based pricing? So I still think it's that MRR, ARR contracted, and then variable revenue next.
Where do you see valuations going? Are they going to stay flat? I mean, has just been some of the air let out of the market and we're kind of back to normal? Or where do you see that over the next year or two?
Yeah, I mean that's hard. I mean, before
Sure.
the bubble burst, maybe that ballpark range for SaaS companies was 5 to 10x of ARR. And of course, depending on your financial profile, what's going on, very specific to business, can you push it up to 10 or will you be closer to 5 or a little bit low? Now maybe that's come down. Before it was like, 3x of recurring revenue businesses, and it goes from there. Now that football field could be 2 to 6 or 7. Now, there's still tons of SaaS companies out there with great financial profiles that are growing at 90%, 100%, and have great metrics. So it's not out of the realm that maybe they could still get 10x or maybe even above with the right buyer, a strategic buyer. So there's still a lot of SaaS companies out there with a great profile that can argue for a higher valuation.
Makes a lot of sense. And so, of course, the big question, what do you think the economy looks like through the rest of 2023 and into 24? Is there going to be a recession? How deep?
Oh, boy, it's hard. Yeah, that, I think, boy, this is completely off the cuff, but I think it could take at least through the summer to maybe feel comfortable of where the economy, the global markets are going.
Sure.
Where everyone's just very conservative right now, very cautious with cash runways, just to see how things play out. And we probably need time to feel comfortable that the floor is not falling out from underneath us. So it could take into the summer to get us back to a point where, it's kind of that new normal, right? We just get comfortable to the current market environment.
Right.
And, and we've had time to see that, all right, our revenue stream is still stable. We're still acquiring customers, or maybe things have slowed down a bit, and that adjusts, our strategic plan. What are we doing over the next 12 to 24 months? So I think it'll still take a little time here.
That makes sense. So it was really interesting. Salesforce refused to give guidance for the future quarter, and public company, and I didn't know you could refuse, but they just said there's too much uncertainty, and I think that's probably true in a lot of markets. So how should founders be thinking about the future and cash flow in a market where there is a fair amount of uncertainty?
Yeah, I think that's where forecasting is so important, and put that forecast case forward where we think, hey, this is an achievable plan. It's got some stretch goals in there, but nothing crazy. But also just a really conservative forecast. What if things really slow down? How would that affect our cash runway, our cash flow? So I think you really have to do those two types of forecasts just to make sure you're not caught off guard, right? It's so important to be proactive. You don't want to be behind the curve and trying to catch up and cutting heads, cutting expenses just to make payroll, every couple weeks. So I think you have to have that conservative forecast just to see the impact on your business.
That makes a lot of sense. So any specific advice that you would give founders going forward, or one thing that's kind of overarching that you've learned over the years?
Again, for me, right, financial discipline, decisions based on data, and just, again, it's the fundamentals. It's nothing too crazy. One, good, clean accounting, good, clean close process every month, whether that's outsourced accounting or your own in-house accounting team. And then from there, right, the financial statements that you can read and rely on, and then forecast your business. And then for me, even though I love SaaS metrics and calculate SaaS metrics day in and day out, that's the last piece of the puzzle, right? We need all those pieces in place before we can have accurate, repeatable SaaS metrics. So again, just get the fundamentals in place and then start pulling in those SaaS metrics that are relevant to your business. If you're still early stage, maybe it's about growth, maybe it's about retention, your sales and marketing numbers. There's just not enough data yet to make that meaningful for ROI. But if you're 10 million and above, yeah, you should have all your metrics calculated, sales and marketing calculated on the ROI on that. So again, start with the fundamentals and build from there.
Have metrics changed in the way that investors are looking at those over the last year? Or which is most important?
I think metrics are adapting for the pricing models and the revenue streams. I put out some posts like say CAC payback period or LTV. What if you have subscription revenue and variable revenue, right? If you just calculate on subscription revenue, those metrics are going to be way off. So now we have to incorporate different revenue streams into these metrics. I actually just had a call this morning from someone at a really big hosting company talking about, hey, PLG, right? That affects how you calculate CAC and payback and all that stuff. It's like, yes, you're right. It's still ambiguous of how we do that, but metrics have to adapt and evolve as our revenue and pricing models move forward.
Yeah, super valuable. Where can people find out more about you and the SaaS Academy online?
Oh, sure. Yeah. I've got tons of free content at my blog at thesaascfo.com. So thesaascfo.com. You can download my templates, everything, check out how-to guides. Then I've got thesaasacademy.com, free and paid courses, and thesaasnews.com. And I'm on Twitter a lot at thesaascfo. So you can find a ton of resources through those sites.
And we'll make sure and link all of those.
Sure.
And again, if somebody has not been to SaaS Academy, and particularly that the Finance 101, yeah, you should absolutely do that. But there's a lot of great content there. And you put out so much good content in other places as well. So really appreciate what you do for the community.
Yeah, no, appreciate it. Thank you. Yeah, just trying to share my experience.
That's awesome. Well, thanks for being on the show.
Yeah, thanks for having me. Enjoyed it. Appreciate it.
Thanks again to Ben for coming on the show and sharing your insights and resources. Learn more about Ben at thesaascfo.com and, of course, the SaaS Academy. Everyone should sign up for his blog or newsletter, and at the very least, take some of his free courses at the SaaS Academy. We'll link at all highlights, resources, and everything mentioned in today's episode at saasfuel.com. While you're there, please subscribe or follow us, and everyone who subscribes this week gets a random prize from the menu. It's a mystery. And you can't complain or send it back. So would you want to go to a restaurant like the one I mentioned in the opening segment? You ever told a waiter or waitress, like, just surprise me, bring me whatever? I have a few times, and honestly, I've never been disappointed. It's kind of fun. And so after thinking about this story, I'm going to try it this weekend, and we'll see what happens. So message me if you try it and share your experience as well. Well, join us next week for our conversation with Ibrahim Assam, founder and CEO of eCourtDate, a SaaS that makes our justice system more friendly, equitable, and efficient. This is one of those brilliant ideas that's so simple, you'll be like, why didn't I think of that? And it fills a massive need and is super easy to use and solves so many issues. And on our SaaS Fuel Expert Series, next Thursday is Christopher Nelson, an experienced technology executive with 2 IPOs. That's right, 2. He is a real estate investor and author of From No Dough to IPO. He's also the principal and co-founder of Wealthward Capital. Christopher teaches leaders like you and me how to achieve financial independence through passive income portfolios. So be sure to come back and check it out next week. And until then, enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at saasfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSFuel. We'll be sure to read these out on future episodes.